Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 318 for November 8th, 2021. We are recording this one a couple days ahead of time because I am traveling this week. So my name is David Cosbetter. I'm the creator of TimingResearch.com. And today, the option professor is back for one of his solo market updates. So I'm going to go ahead and turn it over to him.
Great. And welcome, everybody. It's a very exciting time to be in the markets here. If you've been getting our newsletter each and every week, we have been very much saying, don't fight the Fed and don't fight the tape. And certainly that's been the way to go. Just a quick introduction. This is Option Professor of OptionProfessor.com. Quick background on myself. I've been in the markets here for decades. I've done hundreds and hundreds of webinars and live seminars on the uses and risks of options for thousands and thousands of investors across the whole country over these decades. And I have been trained in my background very much in the market. So I have experience and knowledge. I'm going to share that with you today. I always start off by saying, though, despite all the knowledge and experience I have, which is extremely extensive, that, of course, there is risk of loss in all investing. And everyone should always talk to their brokerage firm and their broker about their risk tolerance and their suitability and determine exactly what's right for them and make their own decisions accordingly. What I'm going to give you here today is opinion and it is observation, but it is not going to be advice. So again, do remember to discuss any actual investing you're going to do with your brokerage firm and your broker to make sure it's appropriate for your circumstance. Okay. Having said all that, let's dive into the water here. The S&P 500 has been going nuts here in the last number of days. I have a chart on the screen here, and I'm going to be referring to these charts. You can see I've got moving averages. I believe in the moving averages because they're based on what? Time and price. And if you get into trending markets, which we tend to be in, again, they can be a very effective way of trying to gauge where you are in the trend and trend up and down and that kind of thing. So very much we have a 12 SMA, 24 SMA, and a 36 SMA being shown. Today, what we're going over, again, so you know, get a pen and paper ready. We're going to go over what we think on the stocks. We're going to go over what we think on the interest rate picture, which is very important right now. And we have been spot on our opinions, which I'll get into. We're going to go over the commodity sector like gold, oil, grain, et cetera. And then we're going to go over crypto using GBTC and Ethereum as the two things, ETHE. So we got a lot to cover. And again, we've been doing this for decades. So obviously we have quite a bit of experience with this. So we're going to give you our best shot at what we think is going on. All right, let's start talking off in the stock market. The S&P, as you can see, gone way up here. This is a 20-year graph. What does this show you right off the bat? It shows you how extended we are. Why would we be this extended? It's a pretty simple story when you think about it. The interest rates are so ridiculously low since 2008. It took basically a COVID crisis to get the thing to go down. And the response to the COVID crisis was to not only do the QE that we used to do coming out of the great financial crisis, but to put it on super steroids and take the Fed's balance sheet up to like $10 trillion. So, I mean, there is so much money slushed around this economy, handing out money on these credit cards to people, giving businesses these PPP grants. There's another grant called, I think it's ERC. That's going to be up to $30,000 per employee. There is money going out that's a joke. Supposedly, it's $2 trillion of excess capital in households right now. Now, of course, they always talk about real returns. How do you figure that out? I'm going to give you an illustrative example. It's an explanation why this stuff keeps going. Number one is the interest rate versus the inflation rate. The 10-year on its best day is about 150, and the inflation rate is 4 or 5%. You take 4 or 5% and you take away the 150 they pay you on a 10-year, and you got a negative real yield, and it's a big negative real yield. So if you put your money in fixed income, you're guaranteed based on inflation to be losing money. That's why people buy stocks. Okay. The second thing is the return on equity of stocks, right? The companies have a return on equity. If their return on equity is 10, 15, or 20%, and their cost of capital is 2 or 3%, do you realize that relationship is very, very positive for stocks? And it has been. So again, if the Fed is going to continue and central banks around the world are joining the chorus, because we just had them all talk this week, and rather than the Bank of England hiking, they didn't do any hiking. And ECB is saying they're not hiking. And of course, you know, Japan and those people, they never hike. So the bottom line is it's easy money all over the place. And even the Fed gave you an 8-month holiday free ticket. In that, they're saying that they're going to do the tapering, which is going to take about 8 months. And then they're going to look at maybe doing some hiking. Well, you know what they're doing here? They're saying inflation is hot, and they're going to let inflation run hot. Now, one of the reasons inflation is hot is because of supplies not being up for demand, right? So the Fed is very well aware there's 9 million boats in the harbor, and they're very well that those boats are not going to sink. They are coming to shore. And when they come to shore with all those supplies are going to go from tight to probably oversupply. And demand, because people have not been able to go anywhere, they bought a bunch of things, right? They couldn't go out to eat. So they bought their refrigerators and they bought real estate and they fixed up their houses, et cetera. And Home Depot went nuts and Lowe's went nuts and Whirlpool went nuts, right? Okay. But that game is now changing to where we're coming out of buying stuff to buying experiences. And that's why people now are going out to eat and they're going on trips. And that's why your Expedia and your Airbnbs and your reopening stocks are going nuts now, because that money that's slushing around, the 2 trillion, is now being put into experiences. And in fact, the unemployment report today shows you that service and leisure and restaurants and stuff like that, those jobs are coming, they're back in force. Then that's where the jobs are. Education actually had a negative number today. So what's going on? What's going on is the consumer has got a ton of money and they bought all their stuff and now they're going for experiences. And that's why your consumer discretionary and your retail stocks, and again, your travel and leisure and your reopenings are going nuts, and your small caps are going nuts. Okay, so that's what's going on as far as stocks is concerned. The TINA, there is no alternative, is live and well, and Powell just told us it's going to stay alive and well. After these bottlenecks cease in the next 6 or 8 months, the Fed probably knows they won't have to hike then, because these inflation numbers are going to be coming way down. Because again, the supply chain is going to be improving and improving and improving. And rig counts are getting larger and larger and larger. Okay. So again, that's the thing that's going on that's going to change, but it's not going to change overnight. It's going to be changing more than likely, in our opinion, in the second half of 2022. So we're enjoying the ride as it goes on now. We just had a lot more reports. Most everybody has now announced by the end of this week. We got a tremendous amount of stuff. And we did have a Fibonacci number that we had put together that one of the persons we deal with came out with. And he said that, and if you'd like information on the gentleman who we work with on the Fibonacci numbers, please just email us, optionprofessor.com. But his mathematics were showing 47.24 on the S&P. As a 61.8%, shall we say, target. And today we did hit 47, almost 47.20. That's pretty darn close. So we're going to be looking next week to see exactly what happens, because there are some who believe that we may start seeing a little bit more of a bumpy ride, because we have gone on such a big run. And after you go on this kind of a big run, sometimes you have a little bit of a pause to refresh. So again, next week, we're looking for a potential pause to refresh, and we're kind of looking at 47.24 to be a potential ceiling. A 38.2% jump in the S&P would have been to 46.60, and it went through there like a knife through butter. So again, we'll see if this 47.24 area holds up. So far today, it has held up, because again, we went up to that neighborhood and we did roll over a bit. Now, again, that is what's going on in the stock market as far as the S&P is concerned. Now, I gave you a little bit of an overview again on why stocks keep going and why the valuations are there. Again, with this low interest rate situation and negative real yields, I mean, it is really forcing people out on the risk curve. And when the people take the risk and then they win at it, it's like any other human behavior, they take more risk. Okay. And that's essentially what's been fueling this thing. With regards to the situation here on some of the sectors, I'm going to show you some of the sectors that we're following rather than individual stocks, because you guys can get those just by looking at the ETFs that I'm going to mention. You go to the top 10 holdings of these ETFs, they'll tell you what the stocks are that are moving, right? So again, let's start out with the consumer, because we know he's out there spending, and we're right in front of what? All of these. Okay, hang on a second here. Let me go back. Okay. So let me go up here and put in the consumer discretionary, and let's see if we can get that to come up. There we go. Okay. Consumer discretionary, you know, these are where people are spending their money, right? And look at that. Look at that. That thing's been going. But look how extended it is right now. That's on a 5-year basis. This is, excuse me, a 20-year basis. This is a 5-year basis. This is called parabolic. This is called melt up. Okay. And there you go again. Okay. So there's your 1-year graph. If you look at it on a 1-month basis, let's see what it looks like. Still way up there. Okay. So it's got a lot of juice on the upside. This is consumer discretionary. Gives you an idea of, you know, again, why we like to use the moving averages, because this thing's been positive to 185. I mean, you know, it's up at 211. Certainly where you want to start buying is down here and let it ride. Up here, it's kind of a rough racket to start buying because it's very, very extended, right? And that's why we would not be so pounding the table right this second for new money, right? And there is the 5-year graph. I mean, you know, that's kind of parabolic looking. Looking at another area, which is, and this was actually much more reasonably valued. It just really just broke out. This is a retail, and you'll see here, it's just breaking out. It's not nearly as extended as the consumer discretionary, because these are more secondary kind of stores, and doesn't have some of the ones that have really been going nuts in it. But obviously it has a lot of the retailers that people are going to buy for the Christmas holiday, and it's breaking out now, and it's far less extended. This is more interesting to us as far as entry level money, because it's just beginning to take off, as opposed to consumer discretionary, which is very extended. You can see on the 20-year graph as well, just breaking out to new highs. Okay, so there you got two right there. There's your consumer, very much going. Other things we look at, obviously, is we like growth, and growth, because this low interest rate environment, which I'm going to get to right now so you can get an idea of why this stuff is running. Let's go to TLT. Everybody has been telling us interest rates are going to rise, right? We've been telling people that in the first quarter of this year, that was the big spike in interest rates when we went to 175 on the 10-year treasury. Okay, when we went there on the 10-year treasury, this thing went, this is TLT, this is a 20-year treasury. This thing went down to 135. Our position is that's the low. Can you see that the blue line is rising still? And this thing right here is now back above it. So again, as long as we can stay above here and we don't take out here, we are sticking with the concept that interest rates yields, let's put it this way, yields on the 20-year are not going to be rising. In fact, they have a chance of, look, if it goes back up, this is lowering rates. Now, again, one reason these rates could go down is that the front end, the 2-year, might go up, which means people might start saying, hey, listen, this is going to be telling you inflation is going to be going away. And the Fed sees this, because if inflation was here to stay, this treasury in the 20-year would be at a much higher level. And this trend, this blue line, which is the long-term trend, this would not be pointing up. Look at the 5-year. 5-year, you see how it's bottomed out here? Okay, so here, if you're a trader right there, 140 or so, that's your support. And if we take out this 152 area, 153, the path of least resistance will be to the upside, which means it'll be yields will actually be dropping. And that, of course, will also be very positive for stocks. Because again, that would make valuations, again, in this ridiculous joke level. Normally, S&P PEs are like 15. We're now at 20, 25. But again, earnings are also coming in. And again, why are earnings coming in? Operating leverage, which we told our readers about back in March and April of last year, after we had the crash. We said these people have lost all their employees. They've shut down all these things. They're not going to reopen everything, and they're not going to hire everybody back, and they haven't. And that's why these companies, when they get earnings, they really burst, because their operating leverage puts the profit, and the earnings at a much better level, because again, their expenses are lower and their revenues are, some of them are better than pre-COVID. Okay. So again, because the consumer has $2 trillion of extra money in their pockets, and they're going to want to spend it. So it's a very powerful situation. But again, this interest rate picture is definitely boding well that inflation is going to not be around when this Fed is done in 8 months. Okay, there's that's exactly what this read is right now. So okay, that gives you an idea of the interest rate picture. Okay, and again, the reasoning behind it. So again, you've got good lines in the sand on this, 140 and 133. Those are your two lines in the sand. And again, getting above the 153 level is going to shock people if it happens. We could also just, trade sideways here for a while. But again, until we take out 133 on this, and until we take out 175 on the 10-year, we're not going to change our view that 175 is the high. And again, if it does get taken out, Lord knows how high it would go. People say yields could go to 2% on the 10-year or 2.5%. Hey, listen, if it starts blowing out 175, who knows where it's going if it's combined with other things that are going on. Again, a lot of people also are looking at the tech area, because again, this kind of an area does very well when these interest rates are so low, because again, they don't have to worry about deferred profits or, down the road profits. Again, another breakout here. This is on a tech sector, XLK. Okay, another breakout here. Will we pull back next week towards the 160 level, the breakout point? Let's keep an eye on that, because that would be the area where we would be thinking might be a better place to take a shot. You see the 160 neighborhood? Maybe we could get a reaction down. What would cause that? We'll have to see. But right now, it's very, very much up, and it's very, very much extended. Okay, so there you go. That's on tech. We'll give you another one here. Since we're going flip-flopping a little bit here, I'm going to show you something that would be for aggressive traders if they thought interest rates were actually going to be not rising, yields not rising. Okay, look at this. This is called extended duration, which means they've got a lot of things like zero coupon bonds. Very volatile when interest rates move around, as you can see. I mean, when interest rates were dropping, were rising, or yields were rising, this thing had a big drop when yields were rising, right? Now we're seeing that they're turned around, and the RSI is turning around. So this would be a vehicle if you wanted to speculate in the area of interest rates. And you can see that very similar to TLT, only it's more volatile than TLT. It is showing you that there could be a very much of a turn here. So this thing needs to really start closing above 140. About 142 would be great. About 142, start getting above there and then get above here. RSI here is above 50. So, this is where the people are not watching, because there's so much talk on TV about higher rates, right? Well, the Fed just said they're going to taper, and then we'll see what happens in 8 months. That doesn't sound like higher rates to me. Okay, so there you go. This is kind of something that's off the grid as far as what people are thinking. Okay, all right. So again, let's go over to more of the stock stuff. We looked at the tech, and we looked at consumer. Those are big. How about the banks? Now the banks may not be as great as people think, because of why? because they wanted higher rates so they can what? Lend at a higher rate and give you nothing on your savings, right? So that is not up very much today. Of course, it's still very strong, but it's extended. And then your 5-year, again, right on the highs, but not going, look, it's hardly up at all today when everything else is way up. So lower rates are really not what the banks want to hear. And also, are people taking out a bunch of loans? They seem to be flush with cash, so maybe the borrowing needs are not that high. That's possible. And the interest rates they can charge are very low. So, the situation for the banks, are not ideal. And the credit card business, I don't know how many people are using credit cards if they're flush with cash. Now, what could be good for the banks is that the people with the money are the people in the top 20% of the nation, right? Because that's who owns 80% of the stock. But it's a situation where the other 80%, if their rents have gone up 12%, which they've done, and they have other expenses going up, maybe they will use the credit card, and maybe that would help the bank, because the people that are not in as good financial position, if they have to keep up with the Joneses to keep, going out and spending money, they may have to hit the credit card. That could be helpful to the bank. But right now, it seems like the banks are having a little bit, this is on an ETF. Let me give you the XLF. And you can see a very similar chart situation here. It's actually down on the day. So you can see it's having some trouble up here. Again, because again, the yield situation has gone from interest rates are rising to interest rates are maybe not, yields are not rising. Okay, let's talk about value, because again, that is something that that supposedly benefits from higher rates, right? Okay, so let's take a look here and see what's going on there. This is the value ETF. Yeah, again, up a little bit, a little bit better than the banks, because there's other stuff in value, like industrials, like materials, like other stuff, oil, etc., that could maybe help this a little bit better. So again, value still looking pretty good, but certainly not running like the rest of them are. With regards to dividends, this isn't everything rally, obviously. Dividends doing a little bit better. So, dividends and value are not way extended as much on a short-term basis as the other stuff. So there could be, like I say, something to be said for looking to where, they haven't gone nuts as much yet. This is a 5-year graph, and you can see, it's tugging the line here. And that's not much real estate between the price, 41.36, and about $40. It's only about $1.36. So, and the RSI on this thing is above 50. So it looks to us a little bit like value and dividend, might be something that, if things are going to keep going, could play a mean game of catch up, or at least your risk reward from where it is trading is a little bit closer to sea level. And that's your value and your dividends, SPYV and SPYD, just to give you an idea. So, again, the other thing that people are jumping on that are going nuts is semiconductor software. Absolutely gone nuts. SMH is what you use for that. And look at that. That's parabolic if you ever saw it. Let's look at the 20-year to put it in perspective. Quite a jump. There you go. So is that a parabolic blow off? We're going to find out next week, because, again, this was pretty much panic in week by everybody. If you were short the market, obviously you covered all your shorts. If you are out of the market, you're coming in. If you're winning in the market, you're pressing your bet. One thing there's probably not is a lot of willing sellers. You know why? Because everyone's making so much money on their stocks. If you went to your neighbor and said, I'm selling out of my stocks, they'd think you had 3 heads. So the amount of sellers in this environment, with the Fed coming out and saying, we're easy Joes for 8 months, and with the earnings coming out, I think it's 30% above, they're growing 30%. And I think it's I think it's about 90% surprising to the upside. You're going to have a stampede, and that's what you're having. This is something we told readers about last month, that Q3 earnings were going to be fantastic, and the likelihood of the Fed being aggressively hawkish was very low. And you can see that's a worldwide phenomenon. We had the ECB, you had the Bank of England, they're all being doves, and the Japanese are always doves. Okay, and of course, China's got a slowdown going on, so they got to be doves as well. So again, this is an environment where credit and money is all over the place. All right, so there's your semiconductor. Gave you another idea there to keep an eye on, along with tech and along with growth and value, which again are definitely moving at a slower pace than the other. The other thing in the markets right now would be international. And let's take a look at international, because again, our consumer is a spender and our trade deficit is at a record level. What that tells us is this: if our trade deficit's at a record level, that means international companies and countries, right, are sending their stuff to us at record rates. And we are what? We are going to buy that stuff. Well, if we buy their stuff, shouldn't that help their stocks over there? And the valuations on some of the stuff overseas is not too shabby. So let's look at some of that stuff and see if there's value there, because, there's got to be other things to do with your money than buy the all-time high on some of this stuff that's extended extremely well. Is there a potential to rotate some of that money into the next game in town? Well, let's see if there is a next game in town here. Let's start out with looking at what's going on in Europe. And I'm using ETFs so you can just basically get a broad-based look at it. But let's take a look at Europe. We'll start out with XGK, and we'll start out with the 20-year graph so you get an idea of what's going on. Okay, this thing since the crash has been going up, and it's been holding the red line, which is the 12 SMA, which comes in at 65.74. Okay, we're trading 69.75, not that far away. Then you go to the 5, and where's the RSI? Your RSI is above 50, looking good there. How about if we go to Europe and we hit the 5-year? There, you got a lot of congestion. You see all those highs? Is that going to be like the Russell, which just broke out, which I'll show you in a second. But look at that. If you get above there, it looks like it's going pretty good. On the 5-year graph, where's the numbers? Numbers coming in around $68. You're only at 69.75. That's not far. 68, 60, 67.50, 68.50, and you're at 69.75. That's not too far. And your RSI is at 59. Let's look at the 1-year. 1 year is turning going pretty good, and these things are all now inverting. Inverting is not a bad thing. That's a pretty lazy looking blue line. You'd like to see that going up. So again, Europe on a 5-year to a 20-year basis look pretty good. And here, if you wanted to keep it on a very short leash, your short leash comes in at 69.20 or so. If you want to give it longer leash, 67.50 and 68.50. But that's not very far. This is something that has not happened yet. That's why people think there's a value here. Not nearly the growth rates we have here, but again, they have low interest, and we'll have to see. Two things that I didn't cover that I'd like to is the small caps, Russell, and then I'll go back to international. Sorry for bouncing around a little bit, but there's a lot to cover. I'm trying to cover as much as I can. Okay, there you go. You remember we were talking about breakout? That's what a breakout looks like. I'll show you a breakout on a 20-year graph too. Yeah, you see this thing was having all kinds of trouble at 230. How many times did it go back and forth? Now it's been in a range of 210, 230. So if that window is really the sideways and you measure the window, you could have quite a bit more potential here. RSI is just really turning up. It's at, let's see what it's at here. Okay, it's up here in the 60s. Here you go on the 5-year on the Russell. So again, next week, if there was a pullback to the 230, 235 range, that might be the neighborhood if you were looking for something new. Okay, but this thing is breaking out, so you don't know if it's just going to keep going. Here's the 1-year graph. Okay. So as you can see, above 230, 235 was the breakout. So if it does pull back towards 230 or 235, and you wanted to look at it at that point, and you were bullish, that might be the neighborhood to do it. Okay. The second one is your transportation average. Now that got a little weird because of what happened to Avis, CAR, Avis budget, because of that meme trading where they just took the 20% short interest and really ran it. But here you go. This thing on a 20-year basis, again, this broke out above 260, 265. Yeah. And now again, it's up near the high here again. So it did have a high here. Will it go through that? Probably. Will it happen right away? We'll know next week. Because again, if it does pull back, let's see where it logically might do that. Yeah, a lot of support at 260. And then if you go to the 1 year, if it's going to hold the red line, it could pull back towards 271. I'm going to show you why it got a little crazy there, because this stock here is part of the Dow Jones transports, and it made the transports go up $1,000 in one day. Now they're just making a joke out of this, like they do on some of these stocks. They took the short interest of 20% of the stock, and now look what they did here. They brought the stock from 171 up to 550, then back down here to a low of 271, and now you're trading 292. So obviously this is a real company with real earnings and real situations. And again, when the guys start doing short squeezes and stuff, how do you figure this thing out? Which also makes the transportation a little bit looking weird, because the actual transportation index went to 18,000 and change, and now it's in the 16,000. So at any rate, that's the culprit when you're trying to follow the transports. All right, so we are showing you the small caps and the transports. Now we're going back over to international. We talked about Europe. It looks pretty reasonable. Now, how about Pacific Rim? This is an ETF on the Pacific Rim. Who's the Pacific Rim? Japan, Korea, and what? Australia. Now, Korea's exports are going nuts to us. So their products are out there in the harbor ready to get bought. And if they get bought, you would imagine what? That in the next 3 to 6 months, the earnings for these companies might go up. That's what you could possibly speculate on. Now, on a 20-year basis, let's see what's going on. Still very much in an uptrend. It is what? Basically got an RSI above 50, and it did penetrate the 12 SMA, but where's that now? 81.34. We're above 81.34 today. So if we can stay above 81.34, that would be very, very good, because then that would be holding the SMA, which is rising, which is good. Let's look at it on a 5-year basis. This one here, they all coming into roost here at about 82, 82.50. So obviously getting above 82.50 would add more credence to the concept of a breakout. And look at your RSIs only at 53. So if it starts breaking out, that RSI's got a lot of room on the upside. And when an RSI gets above 60, that's when you generally get an acceleration phase to that direction. When an RSI breaks 40, you get an acceleration to the downside. Anyway, get me above 82.50, and I think we'll get some price confirmation that this thing is going to go. On a 1-year basis, it is breaking above all these numbers, which come in anywhere between about 80.50 and 81.25. So stay above 81 would be great. 81, stay above there. It's going to be very good. Okay. And that's not very far from 81.84. Okay. That's your Pacific Rim. Again, Korea, Japan, and Australia. Okay, let's turn towards the emerging markets, and you can use EEM for that. Now, this includes China. Okay, now this is another one that has been down because China's been down, but we've been saying that last month, might be the lows of China, because we're going into the Olympics on February 2022. And our feeling is China did all their dirty laundry in the summertime and earlier this year, and they brought everything down. And I think they probably would want a good look on their economy and their markets while the world comes to them in February of 2022, which is only a few months away. So we think there could be some potential for the emerging markets here. Again, we'd love to see this thing get back above the red line there, which is 52.69. On a 5-year basis, we'd like to see it get above, again, where the averages are. We'd love to get it above the 52, 53 area. Okay. Again, when it does that, it opens up all this stuff. So again, sometimes it's better to buy a little higher on its way to higher than to buy underneath it and find out that China is not going to do, they're going to even get worse with their regulations, and they're locking down all these places for COVID again. Although Pfizer today came out with something that said that the pill they're going to have can very much put COVID in the back view mirror with an 89% efficacy. But at any rate, this is your EM markets, and this includes China. And then you go and put the 1 year up there. And again, still needs to get some work here. And China's keeping this thing down because Vietnam's coming back and all the other ones. Let me show you a couple of other EM markets that are looking a little bit better. Our favorite in the EM area is Mexico. And Mexico, we're going to show you the whole chart here. Okay, Mexico is on the upswing here, and we want it to stay above the red line. Red line's 46.30. On a 5-year basis, look at it hugging the blue line. So where do you want it to stay above? You want it to stay above 47.72. You see how it got tested there and came up, and the RSI is at 57. So Mexico is looking okay. On a 1-year basis, today it's looking like it's breaking out to the upside. So can you see that you want it to stay above 49 here? So again, there's your lines in the sand. Keep it above 49 if you want to keep it on a nice short leash. If you want to give it a little bit more room, you go to the 5-year, and you can give it down to 47.72. Any way you slice this, if this thing is going to start breaking out to 52, 54, 56 next year, this is not a bad time to consider it. And again, these guys are exporting everything to us, and then we're going to get stuff made down there. So, there's a lot of reasons why this place could, and to be honest with you, a lot of Americans are moving down there. Playa del Carmen down there in the Cancun area, the Tulum area in that same area, Todos Santos, which is an area down more by Cabo. So, they're getting a lot of Americans who are relocating down there, which is probably not going to kill their economy. Puerto Vallarta is another very popular place to go. So, and of course, what about the leisure? As it opens up, this is a leisure play too. People are going to go back down there and have their fun, right? So you got a pretty good play here in Mexico, EWW. And you can see you don't have to give it that much rope to take a shot. Okay. All right. So there you go. And let's look at India, INDA. And on India, what do you got? On a 20-year basis, we'll look. Again, these guys got a zillion people over there. So if you can ever monetize them and get them all going profitably, this is a pretty big deal. So you've got that looking pretty good on a 20-year extended, but, still looking good. Same thing here. It's been holding the red line pretty good. Red line comes in at $49. You want to give it a little more room. It's down to about $47. And then the 1 year is showing that it's trying to break out here today. And you should look at the short leash right around 49.50. So right here, 48.50, 49.50. Let's see how it trades. Starts blowing out 51. It's going to be going somewhere. Okay. And again, that's another one. Obviously more preference to the Mexico chart, but that's another one. You can see the emerging markets are being held down because China is having their problem. A couple of things you can do in China real quick. FXI. Let's see what it looks like. See if, see, it's still having trouble. Still having trouble. Yeah, down pretty good here. And it's having a hard time. On a 20-year basis, you got to get above 45. You got to get above 45. This is a large cap China. on a 5-year. Yeah, again, very hard to break that trend. But and it could be choppy. Could be choppy because people are concerned. How are they handling this thing with the real estate? Right? Are they going to ditch everybody who is are they going to ditch the American bondholder of those stocks over there, like they ditched the people who owned the educational firms when they nationalized them and said they're non-profits all of a sudden? So that's very risky over there now. People are realizing that what do they actually hold with these things? Is it some deal that's over in the Cayman Islands, or is it actually the company stock? A lot of questions out there, and I guess right now people aren't liking the answer. But that's a big risk when you're buying their debt over there. What do you got? And if you're buying their companies over there, what do you own? And so they were getting off the mat, but now they look like they're on the defensive again. Let's look at some of their Cadillacs, like Baba. And Baba, looked like it bottomed at 140, and it went all the way up to 180. Looked like it bottomed out there. Okay, but now it's totally back on the defensive again. If you're trading it, you got to get above 170 to make it interesting, because it looks, if FXI is any indication, it looks like it's giving it up. What does it look like on a 5-year? Yeah, again, it's a total downtrend. But the bottom line is this formation here is very interesting, because you have a low of 140 ballpark, you go up to 180. So that's a $40 move. What's 61% of 40? It's about 24 bucks. So 180 minus 24. If it's going to hold a Fibonacci pullback, it should hold 156. And what's the low been so far? The low has been 158. So you want it to hold 156 if it's just a little pullback on a Fibonacci pullback. And then if it takes out 180, then you're in the race, because then you got the 1, 2, and 3 formation. So very important for Baba. I would want it to hold 156. And if it did that, that's about as far as I'd give it as far as rope. If it gets back above 180, then I would add, because I would be thinking that this 1, 2, 3 formation is now in force. Because again, the RSI here is right now at 40. If you start blowing out 180 and the RSI gets back above 50, Baba would be very interesting to me. Right here, it's very dicey. Okay, so there is China. And then one last thing on China before I leave the Orient. We're going to talk about the China internet stocks. Okay, and they're pretty much following suit. They had a very, I'll show you on a 20-year basis. They are they haven't been around that long, so let's just use 5-year. And they're playing a rough racket. Again, you got to get this thing back above 55 to even get it going. Let's see what you got here. Yeah, you see it's giving it up just like FXI. So probably you got to avoid China still. Again, they're doing lockdowns again on the COVID. And again, we do have that Olympics coming up in February. So it'll be interesting to see if they can turn the boat around before that date, because my feeling is that they are going to want things to be a lot better looking than they do now when we have the world come to them in February. So we got November, December, and January. You got 90 days to see something happen here. But if it starts happening, that would be the 90 days that it would be turning before those Olympics. So we're keeping an eye on this. It looks terrible, but if it starts looking better, it might be a train to jump on. Okay, so we went over, again, the stock market in the US. We went over the tech. We went over the growth. We went over value and dividends. Now, one thing we didn't go over was energy. Okay, so let's take a look at energy, because that's a big thing. First, let's talk about the price of oil, and then we'll do natural gas. Okay. All right. The price of oil up today very sharply. Again, one of the reasons they got hit is they were worried about what? They were worried about supplies coming from OPEC plus, whatever that means, OPEC plus. Well, they came out and said, we already have increase of supplies that we've agreed to. We're not going beyond that. Well, that was bullish. Okay. And that's why the prices are up today. Now they're talking the reserve, the strategic reserve that's on the table. It's only $80, guys. We got used to it at 147 a few years back, and 80 is not the kind of stuff that's generally an emergency. People don't like paying more. People are not happy about paying more, but it's really not World War III, right? So again, rig counts again similar to the situation with the supply chains. Rig counts are going up, and investing will be increasing, and fracking and all that other stuff may be coming back on. But the guy from Pioneer, he was expecting a tight market looking forward. Okay, because again, we are still millions of barrels light from our pre-COVID levels, and our demand is really coming on. So the supply dynamic is still very favorable for oil, and that's why the prices are bouncing back pretty well here. So again, that's the story on oil. Supply and demand dynamic is still very favorable to the tightness argument, and the ability for these companies to actually go out and produce more and more doesn't seem, the appetite doesn't seem to be. We're going to show you some oil stocks, but I'll tell you what the oil companies are doing, because they got huge free cash flow, meaning they've got huge money that they can spend. And what they're doing is they're spending it on bringing debt down, because when the crisis was going on, these guys were issuing bonds, at such ridiculous rates. I remember I looked at an Oxy Petroleum bond, and it was yielding 35% during the crisis. Well, those bonds are gone, right? And those opportunities are gone because these guys are taking their free cash flow and they're retiring debt, and they're giving out dividends. So people who own these stocks are very well aware they're getting handsomely paid for owning them. That, and also the master limited partnerships are paying very well. I'll show you a couple of those right now. But anyway, so crude does look like it's back on the bicycle a bit. And clearly it has support down here under 70 on a long-term graph. Let's look at the 5-year. Yeah, 5-year, a lot of support in the 73, 75 number. So anywhere between 70 and 75 is very much support. And on a 1-year basis, it came down and tested things at the blue line. The blue line comes in at 82.73. So it dipped underneath it there, but now the blue line is at 82.73. And is that what it's at? Hang on here. Yeah, 82.73. The market looks like it's trading above it. I'm sorry, the blue line comes in at 78.80. My mistake. And so basically it held it down here when it was at the 78. So the 78, 79 area is where this blue 36 SMA comes in. That's not a bad line in the sand if you want it to be bullish. It starts breaking underneath that, something's going on. So the bottom line is you got a nice line in the sand here. You're getting above the 24, which comes in at 81.45. So if you can get above 81.45, that would be another good sign. And then the last line in the sand up here at the 12 is at 82.73. So there's 3 good numbers to work with as far as if you want it to be bullish. You want to have something that you use as a floor. Right there would be about it. So that's your crude. Now let's start looking at some of the ways to play it. XLE. These are your major oil firms on the energy sector. And this is going to be looking good, staying above the 24 SMA is 57.26. So anywhere between here, which has never been tested lately, which is $55 and change, that's a line in the sand, and then up here. So if it starts breaking under here, you want it to hold down here. Long-term graph, just to show you. Again, that's a sloppy looking graph because the blue line is still not even going up. But look here, it was going sideways on the blue line on the 36 SMA for a long time. And this market went all the way up here to 100. Okay, on this particular ETF. So, there's a lot of real estate up here. There's a big game of catch up because the price of oil, the last time it was at 80, these stocks used to be much higher. So again, unless oil is going to go down because inflation backs off or because, again, investment comes in, is unknown. But right now, this thing looks like it's getting back on the bicycle here. And again, using lines in the sand here, it's probably not a bad idea. You obviously can see 45 is one, but the way all these things come in between 52, well, let's call it 51 and 53. That's really where all your support is, 51, 53. And here's a high point here. Maybe it'll pull back here and give you a test. That high point comes in around 56.5. So there you go. That's for the big guys. Now let's look at the different ways of playing it. We are looking at OIO. Well, I'll give you this one first. XOP. And XOP is called your exploration and production companies. And obviously they are going pretty good on the 5-year. And so there you go. You want to, and look at all the real estate up here if it got moving again. So you got support 90, 95 on a 5-year basis. On a 1-year basis, came down and tested the 24. So you got some support here at 106 ballpark. And then you've got some support down here at about 102. So again, there's your oil exploration. And okay. And then you got your oil services, which a lot of people think this is where you want to be right now in oil. And these are companies like Schlumberger. And see, these ones are going pretty good. So this might be one to keep an eye on because, again, it looks like it could play a good game of catch up. So look at the oil servicing. I think it looks like it might have the best value out of all of them. 20-year basis. I mean, look at this thing. If it ever got going, huh? I mean, this thing's down here at 218. So if this thing got going, there's a lot of potential to it, right? And where do these averages come in? Anywhere between 190 and 205. That's long term though. And let's see where your RSI is. Your RSI is still a little weak. How about on a 5-year? Yeah, you see here, it all comes right in here. They're all coming in here at 200, well, call it 200 to 205. 200 to 205 looks like where all the support is. And look at your RSI, it's at 55. So this thing is starting to perk. Let's look at your 1-year. Because again, these people would get back into if they start looking for oil. And it looks at these prices, and if the prices go higher, like some of these executives think, prices are going to, supplies, demand is going to be tight for the foreseeable future. You're looking at a pretty good situation here. So the bottom line is take a look at OIH. That might be worth your while. Again, you got support, as we've been saying, around 210, 205, 210. And then you've got a possible breakout here if we can get above 220. So keep an eye on that. That might be interesting. Because again, the higher oil goes, it will draw the people looking for oil out. And that's what these guys do, oil servicing, Schlumberger, Halliburton, these kind of people. Okay. Let's take a look now at a couple of things before we run out of time that I have not spoken about, which is metals. Okay. And crypto. Let's take a look at gold. We've been very good with the gold. And I'll tell you why. Because we've been very patient with the gold, right? Patient. Okay, when gold ran well up here to 2,100, we were suggesting people not do it, okay? Not do it, because that's called a parabolic move, and it's so far away from the moving averages, that is just not the time to do it. So again, we've had a pullback, and it's been kind of coming down ever since. It's right now converging in very important areas. Now, you see how it's up big today? I'll tell you why. Because it's getting back above its 1-year average, which is what? 1,800. Okay. Now, the key here is, can we hold it? Because it got above it here, here, and here, and then it came back down. And here it really scared everybody out. But now it's been trying to hold the 24 SMA, which comes in at 1772. Today's low is what October, November low is showing 1761. Okay. Your RSI is at 58. That's not bad. So this is the long-term graph, right? And so this is showing us that if we can stay above 1800, and that's what we've been waiting for, then this thing has a lot of potential. Let's show you why. But this has been head fake city. Personally, my opinion, I'd like to see it get above 1850. Then it takes 19, and then after 19, then it goes parabolic, possibly. Okay, on the 5-year graph, your RSI is only at 52. That's not overbought. That's just beginning something, possibly. We have believed that the lows are in, but we have been hesitant to commit to taking positions, especially on a trading basis. Long-term basis, maybe you like it. But the bottom line is on a trading basis, we'd like it to get above this 1850 mark and have some momentum between the 52 RSI. And again, if the RSI can get above 60, that's when it accelerates. So watch this closely, because this could be the week ahead. Again, the Fed has said we are not hiking. That is music to the gold's ears, because gold can see the inflation rate. Gold can see the interest rates are way underneath it, right? And gold can see that paper is all over the place. So, this has been a store of value for a very long time, although it has a long-term history. And sometimes people forget gold is a long-term store of value. And in the short term, it can have a dodgy period. But anyway, we are very much been looking for this thing to close above 1800 to 1850. And if it does, we will give it the green light. What does it look like on a 1-year basis? Yeah, again, it looks like it's going to happen. It just broke above that high. But again, we saw it grow up here and then come back down. So again, is this the real deal Holyfield? It might be, because look at the RSIs jumping at 55. So again, 1840, 1850, that would really start telling us that this thing, the move is happening. And again, sometimes at the end of the calendar year and the beginning of the new year is when gold has some of its biggest moves. So this is our opinion. We think it could very much be time to get in. But again, it's given us head fakes before. You see that? Head fake. You see that? Head fake. You see that up here? Head fake. So is this a head fake? We're going to know over time. Gets above 1850, next spot, 1920, next spot, new highs. And it is definitely not in favor, because everybody says, crypto is the way to go. Let's talk about silver. Silver's had trouble at 25. Let's see if it's blown that out. Probably has. If gold's blowing, nope, hasn't blown it out yet. 25 is the number on silver. You see that? That's the number on silver. You get above 25, it opens up all this white area. Okay. It looks like it's going to do that though. Let's get an idea of why that pullback at 23. You see the blue line? That's the 36 SMA on the 1 year. It held pretty well. Now it's above everything. So again, it looks like it's set up pretty good here. When did this move take off here? If you take 2150 and you go up to 25, you get a $3.50 move. 3.5 times 61%, just rough math, $2.13. 25 minus 2.13, and you're at 2287. Well, the thing, it's all according to where you measure the start from. But this thing came down to about 23, which is pretty close to 2287. That's your Fibonacci pullback. Now, if we take out 25, it should be up and away. So keep an eye on it. A couple of ways to play it. GDX. This thing, you just put your stop at 30 and you let it 31, and that's it. So you don't want it under 31. And if it takes out 34, it's on its way. Where's your get out point? 31 right there, a little bit under 31, whatever that low is. Okay. And then that diversifies you with the Newmont mines and everything else. We love the Newmont mining because, if it stayed above 53, because it pays 4% dividend. So, I mean, as long as this area down here holds, and if we take out here, you're going to be home free. And down here, it's paying about a 4% dividend. So 4% cash flow on your money, and you owned all this gold with Newmont, that might not be a bad thing to take a look at. And that's what we've been encouraging people to investigate. Okay, the other thing on silver, Silver miners. Okay. These are the guys that mine the stuff. So you got GDX for your gold. You got NEM if you want to play a specific one and get a good dividend. And then basically this is your next game in town here. Very similar to the silver chart again. You bottom, you go up, you take a 61% drop, you're there, and now you're trying to take out 41. If you take out 41, you look like you're at the races. Okay, so there you go. Above 21 on 5 on silver, above 41 on this. It looks pretty good. Again, silver and gold have been dead money. And that's why, you know, if it starts to become live money, there's a lot of people to get in it. And some of these short-term traders are not going to miss that. Okay, so the metals are looking like they're trying to turn. Very important day for the metals. The other metals that we like is called industrial metals. And then it includes some of these ones we're mentioning, but it also includes steel. And this one could be also quite good if we get infrastructure ever passed. So this one we're very interested in, and we'll show you why. This is metals and mining. Okay, you can see on a long-term basis, looks pretty good. And on a 5-year basis, again, if it holds this number here, looks pretty good. If we break out above 48, looks like it could go. And on a 1-year basis, again, getting above 46 and then 48, that would give us good, good upside. So that's for the industrial metals as well on a one-stop shop. Okay, I got a couple of minutes here, and I'm just going to go over 2 things quick, and that's crypto. It's hard for us to get excited about crypto because we told everybody in July that that pullback was it, and the bottoms are in. So basically, it's hard for us to buy something that's already almost doubled from where we said it was a good time. Again, where did we get that number from? Going back here, we go to, we'll go to a 5-year graph. That's enough. Okay. We measured where it started from down here up to here and did a 61% pullback. And that's where we got this number around here. So that was about a 61% pullback of where we started down here. Okay. That gave us the reason where that could be the low. Okay. So that's where we were in. Obviously, it gets above the red line, you could add, gets above the green line, you could add, and gets back above the blue line, you could add. So you get in, you add, you add. Up here, it could take this out and take us up to, what is it, 100,000 on Bitcoin, people are saying? Or maybe people will start buying the gold and silver and maybe a little less of this. Anyway, this thing you want to buy on dips. Dips is when you want to buy. See here, you buy the dip, boom. You buy the dip, boom. Okay, here, you buy the dip, boom. You buy the dip, boom. Same thing on Ethereum. Although Ethereum looks better because they have committed to going green on their energy for next year, and people love that. So that's why this is doing better in my view than the Bitcoin, because people are liking their story on and again, when it pulled back here to the 14 is when we got bullish. Okay. So Ethereum does look quite good, but they're both extended up at higher levels, but people like this quite a bit because of the other situation. One last commodity that I hope to squeeze in. I know I'm probably going over a little bit more than an hour, but it's hard to get the world in an hour. Soybeans. We think that this area right around 12 had better hold. If it doesn't, then I think you see it used to have support here at around 12. So if it cannot hold this neighborhood here, that's very bad. This is an area to investigate where you think it might stop. And if it starts going higher, and let's look at the short-term graph to give you that. Yeah, if it can get above 1250, so if it can hold here and then get back above 1250, it opens up all this. But right now it's a big if, okay? Keep an eye on that because again, these grains, they have a lot of different dynamics with weather, okay? All right, this has been optionprofessor.com. The webinar said we were going to go over stocks, international, as well as domestic. We were going to go over interest rates. We're going to go over commodities. We're going over crypto, and we lived up to the billing. We gave you all we got. Now, what can you give us? Basically, 2 things. Go to our website, optionprofessor.com, and you can get on our weekly updates where we update you on what we see, what our opinions are, what our observations are. But better yet, email us at optionprofessor@gmail.com and ask us any questions. Ask the Option Professor. And if you have a question on stocks, international, interest rates, commodities, crypto, anything you've got, throw us the question. Something you own, something you're thinking about, whatever, and we'll give you our best opinion and our best view if we have one. So again, Option Professor, OPTION, PROFESSOR @gmail.com, and throw in your contact information so we can get the details to you. Again, it's been very good talking to you. We had a very exciting week last week. Let's see how the weeks unfold. Some people are looking for a pause to refresh out of stocks. We'll have to see if that 67.24 area holds up. And the gold had a big end of the week last week. And so now we are seeing this week if it'll follow through or if this was another fake to the upside. Again, optionprofessor.com. Happy to be with you. Happy to share our knowledge, share our experience. Email us, optionprofessor@gmail.com, and we'll talk to you down the road. Thank you for being here and have a great day.